December 30th, 2024. Today we started off with a gap down 1.7, 1.8%. And I think the important magnets below were, last week's or 2 weeks ago low down here, since this was essentially near the low of the month. And the monthly chart is becoming obviously very important because today and tomorrow are obviously the final 2 days of the month. So coming into the day, you had to wonder if we were going to try and close the month on its low. I think tomorrow I would pay a lot of attention to, let's say we get a big gap up or we start to get a really good looking rally tomorrow morning. The open of the month is 60.55, which is 100 points above, which is far, but it's not insurmountable. I've seen crazier things. So, tomorrow, if we start to get a sell off and close somewhere down here, then the month will close on its low for the bears, and that's really good. And if we start to get a bounce and we end up getting a close somewhere up here, maybe even above the open of the month, then it will be a bull close on the month. And that is not really good for the bears. So I'd pay a lot of attention to the monthly chart tomorrow if we start to go sideways. Bar one, obviously a bear bar after a really large gap down. It's a follow through bar for the bears, but a large tail on the bottom. So probably buyers somewhere below scaling in lower. Bar two is an inside bar, so a low one short for the bears. Do you sell below the bar two low? I probably would not. You can, but you're taking a chance. This is a big bear bar with a follow through bar on one and then a low one. So you're hoping that basically we're going to start a bear channel here. And your calibrated expectation is that you're going to get some sort of good looking follow through. So it's kind of difficult to sell below two because of the area. And there's an 80% chance of a minor reverse. We might be heading back to the open of the day. And it's obviously the market's about to close. I think that I'll get over to that in a minute, but selling below two, the bell is about to go off, so just be aware of that. But selling below two, not really as good as it could be. Three, follow through, but a large tail. So if you sold below two, is three really that great? It's not really that great, but it's not terrible either. So that's kind of the problem, is you're getting mediocre follow through. Four consecutive bear closes, but a large tail on one, a tail on three, a tail on four. So as it is a 4-bar micro channel, which I talk about a lot. However, with all these tails and with how far below the moving average we are, odds are it's better to buy the close of four and try to get back up to this area than it is to sell the close of four and try to get down to this area. Because of all the tails, it's a parabolic wedge on a lower time frame. Really not a very good looking sell. 5, sellers above 4 during 5, so expect to get at least a small second leg sideways to down. 6, a big bear bar, but not really that great to short. If you do sell, you're hoping for a collapse down to last week's low, and you get a disappointing bar on 7. So 7, a big doji bar, but a bull close. Not really what you wanted to see if you sold below 6. 8, bears buying back shorts, probably around the 6 low, so that's causing 8. And then buyers below 8, a bad low 1 short, because it's a leg 3. So when we go below 8, it's the third try down, the first to 4, the second to 6, and then the third 9. So buyers below. Outside up, probably sellers above, scaling and higher. I think at this point, we're probably not going lower. And if we are going to go lower, we're going to get a really good looking bear bar closing near its low. And we did get that really good looking bear bar closing near its low on 10. And I'm going to talk about what I did today in a minute here. But one of it started with basically bar 10 related to my first couple of trades. So bar 10, a bear bar closing near its low. What's your calibrated expectation? What do you need to see out of 11 in order to make you think that it's a good trade? Well, I thought that if I was going to sell below 10, I would want 11 to be a big bear bar closing near its low, closing below the low of bar 7. And that's exactly what bar 11 was. So in my mind, I thought that it was okay to be short since 11 was a perfect follow-through bar. The obvious issue is you're probably selling a third leg down. So it's a delicate situation. If you're going to get short, you need to be really quick to get out. For me, as 12 was bouncing, I sold the 10 low because I decided that if 12 bounced up to here in the first minute and a half of the bar. I basically decided that if 12 was able to become a bear bar, then we were probably going a good amount lower. So I sold the limit order after getting the follow through on 11, taking a chance that we were going to get a good looking bear bar or a bull bar that does not close above its midpoint was my requirement to stay in the trade. So if 12 was a bull bar that closed above its midpoint at all, I was going to exit the trade. And it wasn't. So I stayed in the trade at the close of 12. And then we got 13. And basically, when I saw 12, I thought that 13 needed to be a good looking bear bar closing near its low in order for us to go lower. We probably needed to start to collapse. And instead, we got a bull bar. So what did I do with 14? Well, I saw 13. I saw 13, and I know that the bears are disappointed with 13. There's only one real thing that can happen on 14 that will save the bears trade and make me think we're going a lot lower. And that's a big bear bar closing near its low. So I exited my short on the close of 13, knowing that this was a big problem for the Bears. And I bought as 14 was pulling back, knowing that the only thing that would make me feel good as a bear would be if 14 is a big bear bar closing down here. So I bought as 14 pulled back, and my only expectation was that 14 not be a big bear bar. I was hoping it would be a bull bar. I didn't know what it would look like, but I was hoping it would not be a big bear bar. And obviously I got 14 and I scalped out at the top of the channel, the bar 5 high. So I lost a little bit on the first trade, but I more than made up for it on the second trade. I had a really, really good day today. I obviously had that trade. I bought above 19 and I added during 21 because the same thought process. I know that, after 20, so my calibrated expectation buying here was that 20 is a good bull bar. If I'm going to buy above 19, a bear bar, right on the moving average, I want 20 to be a good bull bar and punch through the moving average. And that's exactly what it did. As 21 was pulling back, I know that 21 should not close on its low if this is going to be a bull trend. And so I ended up basically, as 21 pulled back, I bought somewhere in here, and I was going to exit below 21 if it closed on its low, but it didn't. I scalped apart here, and then we got 23. I exited the rest. But then if you have to ask yourself, what would it take for bulls to get long again after 23? What's the perfect bull trap or the perfect bear trap? Well, 24 and 25 consecutive bull bars closing near their highs and closing above the 23 high or at or above the 23 high would be considered basically a perfect trap. And so I bought again, I exited part here, and then I held the rest to somewhere up here, and then I got out of the rest up there. So I basically caught most of the entire move up, and then I was done for the day. I thought there was some stuff you could have done over here, but it's a little bit counterproductive to trade at trading ranges in general, so I just try not to do it. Obviously, if you have the right system for it, then it's fine. But the way that I trade, a lot of breakout trading, it's not really that great for this environment. So I thought that it was a trading range day. And if it is a trading range day, support and resistance is going to get tested. And so I thought that yesterday's low, the 38 low, was probably an area where there would be sellers. Or we would probably get there considering the fact that we were already in an early bull trend and that it was probably going to be some sort of trading range. So 14, a good bull bar, probably going at least a little bit higher, but should get a pullback first from the tight channel down, and considering that we haven't gone above the moving average yet today. 15, 4 straight bull bars, 12, 13, 14, 15, probably sellers above, somewhere scaling and higher, and then a big outside down bar on 16. But 16 is more of a buy the close bar than a sell the close bar after 12 through 15. You know that it's going to get a second leg up. So I wouldn't be surprised if we went one tick above the 16 high. Would I buy the close of 16? I mean, you probably can, but it's one of those things where if you're taking that, it's kind of risky. But if you do buy the close of 16, you need 17 to be a bull bar closing near its high, and you need good follow through. So if you buy and 17 is a disappointing bear bar, you just got to exit the trade. 17, a bull bar closing on its high. So good for the bulls. Expect another leg up. 18 consecutive bull bars. If you did buy above 17, what's your perfect follow through bar? 18 is your perfect follow through bar. So I think that you can also buy the close of 18. 19, an inside bar, a high 1. It's not really a great looking bar, but if we go above this bar, should we get an outside down bar? No, this should never be. If you're buying above 20, 21, sorry, if you're buying above 19, 20 should never be an outside down bear bar if this rally is going to work. So once you trigger the buy, you can just put a stop below 19 and bet that it's not going to be an outside down bar. And as I said, my expectation buying was that we get a basically perfect bull bar. And we did. So that made me think it was probably a trend. 21, a bear bar, but you can see traders were buying below and it closed above the moving average. So probably going to get at least one tick above the 21 high. 22, a big bull bar, and it broke above the 1 high. So probably going to go at least a little bit higher, but we might pull back first since it's a trading range day and we just broke above the high of the day. But obviously the channel up is really tight. There's nothing to sell. So 23, a bear bar closing near its low, but it's just profit taking. Look at how tight the channel is from 12 to 23. And we're in a micro channel since 16 to 23. So, whatever 6-7 bar micro channel and a really tight channel up and magnets above being yesterday's low. No reason to short. 24, a bull bar closing near its high, possibly a trap for the bears who sold below 23. So their buyers below 23 during 24, a bull bar closing near its high. Consecutive bull bars, 24, 25, probably going higher. Bears are trapped. 26, 3 straight bull bars, good for the bulls. We're going to get a second leg up. Okay to buy the close. 27, a good bull bar, but climactic. So when you get a buy climax, I've noticed a lot in my 4-bar micro channel study, when I do get a buy climax like 27, it's probably going to pull back first. If 28 is even a 1-tick doji bar, it decreases the chances of a deep pullback. But when you get this climactic of a move, you're probably going to get a deep pullback first. And you did on 28, a big bear bar closing near its low. Bulls will exit below 28. Bears know they're probably going to get a second leg, so some will sell, hoping to get below 28 and start, the first of a couple of legs down. And instead, what do we get? A bull bar closing near its high on 28. So the bears who sold the close of 28 see 29, and they think, uh-oh, I'm trapped in the trade. And they start buying back their shorts above 29, causing a bull bar on 30. So consecutive bull bars, 29, 30. 31, another bull bar, a tail on the top. 3 straight bull bars. We're probably going higher. You'd see buyers below 31 during 32. Probably sellers above 32, scaling in higher. But again, it's a bull trend, so you buy for any reason. 33, a bull bar, but a large tail. Initially, sellers above 31. 34, an inside bar, a high one buy for the bulls. At this point, it's just a question of, are we going to get to this magnet, this 38 low from yesterday? Are we going to get here before we pull back? 35, another bull bar, good for the bulls. Again, we're going to the magnet. 36, 37, we got to the magnet. Do you buy these closes? I don't know. It's a late leg up, so buying late legs is not really that ideal. You probably want to look more to buy early legs up that are going to lead to more legs, but late legs often lead to deep pullbacks. You probably won't be able to see it on the screen, but on 12, 27, 24, 61 through 64 is a late leg up in a range. So we have this whole bull channel and then a really late leg. We have this whole bull channel and then a late leg. So those strong late legs will often trap traders into thinking that's going to be another bull trend, and then it just goes sideways. 38, a bull or bear bar, probably buyers below, probably sellers above. An outside bar, 39, so consecutive outside bars, 38, 39. We might go a little bit higher, but this is a final flag. We should get back to this price. 40, a big bull bar closing near its high, but this is a climax. It's a breakout above a bull channel. We have a bull channel and then a breakout bar on 40. And 40, 60% chance that we get pullback and 60% chance of a second leg up. 41, a bear bar closing near its low, probably buyers below, scaling in lower. A big bear bar, a bull bar 42, but really just a trading range bar. I would not do anything at this point. I think we've reached the magnet for the bulls and we've gone up too far too fast for us to go much further up, but the rally up did too much damage to the bears for us to go down. So I probably would not look to sell either. 44, it's a high two, you could argue, but it's just in the middle of a trading range and we're in the area where we're going to start to go sideways. So I would not do anything. 45, consecutive bull bars, but what are the odds we start another bull breakout after so much upside? Not very high. 46, a bear bar, probably buyers below, scaling lower. 47, consecutive bear bars, but traders are going to buy the moving average. 48, a doji bar, sellers above. 49, consecutive bull bars, but again, you're buying or selling in the middle of a trading range. If you're doing anything from bars, it became obvious it was a trading range, I think, on 41. It was probably a trading range on 40. But I was a little bit obvious on 40 that it was going to be a trading range. But you could argue 41 is when it became obvious it's a trading range. And if you did anything from 41 to 51, or really 41 to 76, you were just trading in the middle of a trading range. So it's really not that great. So as much as we rally a little bit, 51, disappointment, 52, bull bar 53, but 3 legs up, 49, 51, 53. 54, 55, bear bar is getting a little bit lower, but bottom of the trading range is the maximum we're probably going to get. And yes, 4-bar micro channel to 57. I would personally wait for 50. Well, okay, so my signal is to be 58 to short, but I don't want to sell. I know that we're in a trading range after a bull trend. And if we're in a trading range after a bull trend, we're probably still always in long. So I still think we're always in long. Where do you want to buy? You could buy the close of 58, but where's the bottom of the trading range, right? Where did the trading range start? Probably on 40. So what's the lowest we've been since bar 40, the bar 42 low? So it's credible to think the 42 low is the bottom of the trading range. And you could buy on a limit order at the 42 low during 59 since it's the bottom of the trading range. And what is your calibrated expectation for the trade? Well, if you're buying this low, you're buying as 59 is becoming a bear bar. And so your expectation is that 59 should not look like 41. 59 should not be a big bear bar closing somewhere down here. And if it is, you just take your loss below the bar and you exit the trade. Don't worry about it. But since it gets bought up so much and there's such a large tail, you now know that it's an increased chance that bears are going to buy back shorts. 58 is an inside bar. 58 is an inside bar in a low one short, but you have to imagine that there's buyers below a low one short at the bottom of the trading range. And when bears who sell below 58 don't get a massive follow-through bar on 59, they'll be disappointed and buy back shorts, and that causes 60. 61, consecutive bull bars, but a large tail. 62, buyers below 61. 63, another bull bar. And basically, we just bounced for a couple legs and then sold off 71, 72. Do you sell the close of 72? Well, if you sell the close of 72, what's your calibrated expectation? If you sell the close of 72, I think you want 73 to look like 28. Oops, that's not quite there. So you see 72. I want 73 to basically be a duplicate bar. I want it to collapse. And what do you get? A doji bar. When you get the doji bar, some bulls, it's not great to buy the close because you know this is going to get a second leg. But some bulls buy looking for a bounce, so that bears buy back shorts. And we get the bounce. Where does the bounce go? To the top of the channel. What's the channel? 73 is a channel on a lower time frame. Spike, pull back on, let's just do it this way. Spike on 72, and then pull back during 73, and then a bear channel. But the channel, obviously only a bar or two, but markets are fractal, right? Spike, pull back 1, pull back 2, pull back 3, and then we got a bounce and then a second leg down. So you have to understand that if you're selling 72 and then you get 73, probably going to be a little bit more of a channel on a lower time frame, and traders will buy back short 74, 75. And then you could say, well, if I sold and I held, it went. Yeah, but if you're selling and then you see a lack of momentum, 73, 74, 75, it's probably better to get out and look to get back in if you get a convincing bear bar like 77 closing on its low. The nice thing about 77 is that it's a second sell. So sometimes the first sells pull back and then get second sell signals, and the first sell would be 72. Once you get the pullback to 77, your calibrated expectation on 77 is that this bar basically collapses. You want 78 to be a big bear bar, and if it's not a big bear bar, you just exit the trade. Obviously, it does end up being a big bear bar, and you make money. For stop orders on the day, maybe 2, but not great. Maybe 10, but not great. 13, 14, 17, a little risky. 18, 19, better. 20, it's all by the close, basically up until, I would say, you could buy the close at 34, but you're buying high. So anything higher than that, you have to understand you're buying basically the top of probable developing trading range. And then you see 40 traders exit. And then I would not do anything else until probably 77 on a stop order. On a limit order, what's my favorite limit order trade today? I would say probably buying below 31 is pretty good. And you know that just 32 can't be a big bear bar closing near its low that needs a second leg. So a small bear bar is fine. But if 32 is a bear bar closing near its low that needs a second leg, we're probably in more of a trading range. So I would say that would probably be one of the better ones, is buying below 31. So the daily chart. See, 3 bars down, 3 bars up, 3 bars down. We're probably going to have to go below this low because this should get a second leg and the sell-off lasted to this low. So we should get back down here. We did keep this gap open with the 12.17 low and the 12.26 high, but I think we're probably going to have to get back into this area because of how strong this bounce was. The downside is limited because of how big this bounce was, but we still might go a little bit lower before we bounce. And when we bounce, I'm not really sure what it's going to look like. The weekly chart, I suppose it doesn't really matter. And as I already mentioned, the monthly chart is going to be important tomorrow. So the bears want it to close as bearish as possible, as close to the low, and the bulls want it to close as bullish as possible, as close to the high. So if I were you, I'd pay a lot of attention to this area. All right, that is going to be it. That's going to be it for the day, and that will be it for the review. There will be a video tomorrow.